This is the second complete comprehensive example without adjustment of capitals in the chapter Retirement of Partner. Let's go to the example sum. Example sum. Following is the balance sheet as at 31st March 2019 of Messrs. Gopi, Krishnan and Ram, who share profits in the ratio of 4/7, 2/7 and Ram 1/7. To the left of the screen we have the balance sheet given. On the right, additional information. Gopi retired on 1st April 2019 and the following terms were agreed upon. First point, goodwill of the firm is to be valued at rupees 21,000. Second point, assets and liabilities are to be valued as under: stock rupees 12,000, sundry debtors rupees 10,500, land and building rupees 22,600, plant and machinery rupees 25,000 and sundry creditors rupees 14,000. Third point, Krishnan and Ram were to introduce rupees 20,000 and rupees 5,000 respectively into the business, and rupees 16,200 were to be paid to Gopi. The balance due to Gopi was to be paid in 3 equal annual installments along with interest at 9% per annum. We are asked to prepare the revaluation account, the partners' capital accounts, balance sheet of the firm after Gopi's retirement, and Gopi's loan account until it is finally paid. We'll begin with the revaluation account. Then we'll go ahead with the partners' capital account. We'll complete the balance sheet, and any working notes related to this we will do after the balance sheet. And finally, we will prepare Gopi's loan account. Let's go to the solution. Solution. Revaluation account. Left side debit side, right side credit side. Particulars: rupees, particulars, rupees. The first point in the additional information, it's about goodwill of the firm. Let's go to the second point. Assets and liabilities are to be valued as under: stock is to be valued at rupees 12,000, book value 15,000. There is a reduction in stock of rupees 3,000. To stock account 3,000 rupees. Sundry debtors rupees 10,500. Book value 11,000 to be reduced by 500 rupees to sundry debtors. Account 500 rupees. Land and building 22,600. Amount given in the balance sheet is 20,000. So buy land and building. Account 2,600 is the increase in value. Plant and machinery rupees 25,000. Amount given in the balance sheet is 26,500. Decrease of 1,500 rupees to plant and machinery account. ₹1,500. Sundry creditors to be valued at 14,000. Book value is 15,000. Reduction in liability by creditors account 1,000 rupees. Debit side total is greater. ₹5,000. ₹5,000 minus the total of the credit side is 3,600 rupees. So we have a loss of 1400 rupees by loss on revaluation transferred to partners' capital accounts. We have Gopi, Krishnan, and Ram. The total loss 1400 rupees to be divided in OPSR 4:2:1. 800 against Gopi, 400 against Krishnan, and 200 rupees against partner Ram. This is a revaluation account. Let's go ahead with the partners' capital accounts. Partners' capital accounts. Left side debit, right side credit. Particulars. Gopi, Krishnan, Ram. Again particulars. Gopi, Krishnan, Ram. We'll begin by bringing down the balance of capital accounts by balance brought down. 30,000 for Gopi, 20,000 for Krishnan, and 15,000 for Ram. Loss on revaluation, we'll transfer it to the partner's capital account, to revaluation account. It was 800 in the case of Gopi, 400 in the case of Krishnan, and 200 in the case of Ram. Next we'll deal with the reserves. There's a general reserve of 10,500 rupees. We'll distribute that by general reserve. Account. We need to distribute 10,500 in OPSR 4:2:1. So we have 6,000, 3,000 and 1,500. There's existing goodwill of rupees 7,000 in the books. It needs to be written off in OPSR 4:2:1. So to goodwill account 4,000 rupees for Gopi, 2,000 against Krishnan, and 1,000 rupees against Ram. We'll deal with point 1. It says goodwill of the firms to be valued at 21,000. We'll do the working notes for this. Working note 1. Treatment of goodwill. As per the sum, firm's goodwill is equal, as per point 1, it's rupees 21,000. We have the OPSR between Gopi, Krishnan and Ram given as 4:2:1. Gopi is a partner who's retiring. So Gopi's share of goodwill is equal to firm's goodwill 21,000 multiplied by 4 divided by 7, which is equal to rupees 12,000. There is no mention about the gain or the gaining ratio or the NPSR. Hence, the gaining ratio between Krishnan and Ram is equal to their old profit sharing ratio, which in this case is 2:1. So let's write the journal entry for goodwill. Krishnan's capital account debit, Ram's capital account debit, to Gopi's capital account. Against Gopi, we'll write his share of goodwill, 12,000 rupees. This has to be divided between Krishnan and Ram in gaining ratio 2/3 and 12,000 into 1/3 in the case of Ram. So it's 8,000 rupees for Krishnan and 4,000 rupees for Ram. Let's post this in the partners' capital accounts. By Krishnan capital accounts, 8,000 rupees. By Ram capital account, 4,000 rupees. And to Gopi capital account, under Krishnan 8,000 rupees and under Ram 4,000 rupees. We've dealt with goodwill also. The second point we already dealt with. Final point, third point, Krishnan and Ram were to introduce rupees 20,000 and rupees 5,000 respectively into the business. So both of them are bringing in cash into the business. So by cash account, Krishnan is introducing 20,000 rupees and Ram introduces 5,000 rupees. And rupees 16,200 were to be paid to Gopi. So to cash account, 16,200 paid to partner Gopi. And the balance due to Gopi was to be treated as loan and payable in equal installments. So we'll treat the balance as Gopi's loan account. We'll balance Gopi's account and treat the balancing figure as Gopi's loan account. Credit side total, greater total 48,000. Gopi's loan account, balancing figure 27,000 rupees. We'll balance Krishnan and Ram's capital account and write the balancing figure as 2 balance carried down. 43,000 greater total for Krishnan. $32,600 balancing figure in the case of Krishnan. 21,500 greater total in the case of Ram. 16,300 in the balancing figure in the case of Ram. So this is the partner's capital accounts. Let's go ahead with the balance sheet. Balance sheet. As at 1st April 2019. Left side liabilities. and right side assets. We'll begin with the liability side items. Capital accounts. The continuing partners, Krishnan and Ram. We'll check out the balance of capital accounts for Krishnan and Ram. 32,600 and 16,300. Total 48,900 rupees. We'll insert Gopi's loan account. 27,000 rupees. Next item, general reserve, it's been distributed. Sundry creditors. As per point 2, sundry creditors are to be valued at rupees 14,000 and bills payable. No change in value, 2,000 rupees. Continue with the asset side items. Goodwill has been written off. Land and building. As for point 2, land and building is to be valued at 22,600 rupees. Plant and machinery, next item. Point 2, plant and machinery is to be valued at rupees 25,000. Motor vehicle. No change in value, 13,000 rupees. Stock. Stock is to be valued at 12,000 rupees. And sundry debtors is to be valued at 10,500 rupees. As per point 3, Krishnan and Ram introduced 20,000 and 5,000 respectively into the business, and 16,200 was to be paid to Gopi. So we have cash. We'll add up the amount which was introduced by Krishnan and Ram, which is 20,000 plus 5,000, and deduct the amount which was paid to Gopi, which is 16,200 rupees. We have 8,800 rupees balance of cash. We'll tally the balance sheet. $91,900 on both sides. The balance sheet is tallying with rupees 91,900. So this is the balance sheet. Next we'll prepare Gopi's loan account until it is paid. Let's prepare Gopi's loan account. So we found out that the amount of Gopi's loan was rupees 27,000. So we need to pay this in 3 equal annual installments. Along with interest at 9% per annum. So we can infer that each annual installment is equal to 27,000 rupees divided by 3, or in other words, each installment is rupees 9,000. So we'll go ahead and prepare Gopi's loan account. left side debit side, right side credit side. We have date, particulars, rupees, date, particulars, and rupees. The date of transfer of rupees 27,000 from Gopi's capital account to Gopi's loan was 1st April 2019. So it's 1st April 2019 by Gopi's capital account. ₹27,000. So installment is payable at the end of each year. The first year gets over on 31st March 2020. So interest accrues for that year. So 31/3/2020 we accrue the interest by interest account. The amount outstanding is 27,000 and per year's interest is 9%. So we have ₹2,430 as interest at the end of the first year. On the same date, we need to pay the installment along with the interest. So to bank account, the amount of installment is ₹9,000 and the interest at the end of the first year, ₹2,430. Total amount payable, ₹11,430. Let's balance this. Year is over. Greater total, ₹29,430. Balance carried down on 31/3/2020. To balance carried down. The difference, ₹18,000. Beginning of the next year, 1st April 2020, we'll bring down the balance by balance brought down, ₹18,000. At the end of the second year, 31/3/2021, interest accrued by interest account. Amount of interest accrued is 18,000 into 9%. ₹1,620. On the same date, 31/03/2021, we need to pay the installment along with the interest to bank account. Installment amount ₹9,000 plus the interest ₹1,620. Total amount paid ₹10,620. Transactions for the year are done. We'll close the year. ₹19,620 greater total. The balance carried down on 31/3/2021. ₹9,000. Beginning of the third year, 1st April 2021, by balance brought down. ₹9,000 brought down. At the end of the third year, 31/3/2022, by interest account, 9% interest on ₹9,000 for full year. 810 rupees, and final payment on 31/3/2022 to bank account. Amount of the installment 9,000 plus 810 rupees, 9,810 rupees. There is no balance carried down. The loan amount is closed. Gopi's loan has been paid off. I'll remove the split and we can view the loan account. So this is Gopi's loan account. We'll go back to the beginning of the sum to view all the accounts together. We started with the revaluation account. Went on to prepare the partners' capital accounts. Followed by the balance sheet. The working notes for the sum, treatment of goodwill. And finally, Gopi's loan account.